All right, let's get right into it. Now, you've probably heard of trading stocks, right? But there's this other market out there, one that's so massive it just dwarfs everything else. It's running 24 hours a day, 5.5 days a week, and it's a place where fortunes can be made and, yeah, lost in literally the blink of an eye. We are talking about the world of Forex.
So, to give you an idea of just how insane that number is, the entire New York Stock Exchange would have to trade for 30 straight days just to equal one single day in the Forex market. That's about $220 billion changing hands every single hour. It is without a doubt the most liquid financial market on the entire planet.
That's the real question, isn't it? It sounds incredibly complicated, but the core idea, it's actually pretty simple. So in this explainer, we're going to break it all down. What Forex actually is, how a trade works from start to finish, and crucially, the very real risks that are involved. At its very heart, Forex is just the act of swapping one country's currency for another. See, you're not buying a piece of a company like you do with a stock. What you're really doing is making a bet on the strength of one economy against another, just by trading their currencies. Okay, so how do you actually make money from this? It all feels a little abstract, right? So let's make it real. We're going to follow a trade step by step from beginning to end.
So let's meet Mary. She's got 10,000 US dollars in her trading account, and she's got a hunch. She thinks the US dollar is about to get stronger against the Japanese yen. Now, to make this happen, she's going to use one of the most powerful and, frankly, most dangerous tools in all of trading.
And that tool is called leverage. See, in Forex, brokers let you control a massive amount of currency with just a tiny deposit, which is called your margin. So with, say, 50-to-1 leverage, for every single dollar Mary puts down, she can actually control $50 in the market. This amplification effect is what makes Forex so incredibly potent and, yeah, so risky. So just look at how these numbers work out. Mary only uses $2,000 of her own money, that's her margin, to control a $100,000 position. Now let's say the currency pair moves in her favor. She makes a profit of $6,225. But because she only had to put up $2,000 of her own money, her return on that investment is over 31%. That right there is the incredible power of leverage.
But remember what we said, leverage is a double-edged sword. It magnifies everything. So what if Mary was wrong? What if the market had moved against her instead?
And there you have it. That is the other side of the coin. A single loss like that wipes out over 31% of the actual money she put into the trade. The exact same tool that created that huge return can create an equally painful, devastating loss. Okay, so we've seen what can happen when a trader like Mary makes a call. But how do traders even make those predictions to begin with? Well, it pretty much boils down to two main schools of thought. So on one side, you've got fundamental analysis. This is all about the why. These traders are looking at the big picture stuff, economic reports, inflation, interest rate changes, even political drama, all to figure out the health of an economy. Then on the other side, you have technical analysis. This is all about the what. These traders believe that all that economic news is already baked into the price. They just study the charts, looking for patterns and trends to predict what's going to happen next. So, once a trader gets a sense of where they think the market is headed, they need a game plan to actually act on it. And this is where trading strategies and even automation come into the picture.
And the approaches, they're incredibly different. They often reflect the trader's own personality. You've got these high-frequency scalpers who just love the action, jumping in and out for tiny little profits, sometimes hundreds of times a day. Then you have the more patient trend followers. They try to catch a big, long move and just ride it for days, maybe even weeks. And then there are the news traders who wait for a big economic announcement and try to profit from that explosion of volatility that always follows.
And more, traders are turning to automation. We're talking about trading robots. These are basically computer programs built to execute a specific strategy without any human emotion, without any hesitation. They can analyze data and place trades way faster than any person possibly could, and they can do it 24 hours a day.
Now look, it all sounds really exciting. Big money, fast moves, cool technology, but we absolutely have to pump the brakes for a second and have a serious reality check about the risks, the ones that people often don't like to talk about.
This right here is the first and most important rule of this game. There is no magic system. There's no holy grail. If anyone tells you they have one, they are trying to sell you something. Losses aren't just possible, they are an absolutely guaranteed part of the process. Now, this is what happens in a trader's worst nightmare.
when leverage really turns against you. It starts with a margin call. That's basically a warning from your broker saying, hey, you're in trouble. If that trade keeps losing money, you eventually hit the cutoff point. And at that stage, it's completely out of your hands. The broker's system just starts automatically closing your trades to stop the bleeding and make sure you don't lose more money than you actually have in your account.
A lot of traders will use something called a stop-loss order, which is supposed to automatically get you out of a bad trade at a certain price. But it's not a perfect shield. During really crazy events, like a huge news announcement, the market can move so fast that your order gets filled at a way worse price than you wanted. They call this slippage, and it means your loss can end up being much bigger than you planned for.
I love this quote because it just perfectly captures the huge psychological jump from practice to the real thing. I mean, anybody can be a genius trader on a demo account where there's no real money at risk. But the second your own hard-earned cash is on the line, every single decision gets supercharged with fear and with greed. The plank is exactly the same, but the emotional stakes, they're a world apart. So where does that leave us? Look, the Forex market offers these incredible opportunities, all driven by the global economy and supercharged by high leverage. But that very same leverage creates immense risk. The line between a well-calculated trading plan and just a pure, high-stakes gamble can be razor-thin. And ultimately, what separates the two comes down to knowledge, discipline, and a deep respect for just how fast this market can turn on you.